traded for over a year and made literally $0. Not a little bit. I made $0 in a whole year. I blew evaluation account after evaluation account. And for most of that time, I had about $500 to my name. I already know why a lot of you are probably here. You've probably seen someone who's half retarded, who's your age, post some crazy green number online, and you want to learn how you can do it too. Without buying some crazy $100 Discord just to find out it's some guy posting random entries and basically selling signals. I've been there. At one point, I did buy one of those Discords and I DoorDashed like 9 hours just to afford it. I ended up learning nothing and I didn't pass one single account. So basically, this video is everything I wish someone sat me down and told me before I wasted an entire year trying to figure it all out. And by the end of this video, you should know what futures actually are, what NQ is and why I trade it, why I personally don't think beginners should start with their own money, how prop firms actually work, how I read my charts, how I know when I should trade and when I should just stay out, and probably the biggest thing I had to learn, which is that progress and profit are two completely different things. There's no random upsell halfway through this. I'm just gonna go through the whole thing. So if you wanna start trading NQ and hopefully avoid making a lot of the mistakes I made during my first year, this video is for you. Before we get into anything, I want to make sure we're all talking about the same thing, because when someone says they trade, that could literally mean 10 different things. I don't trade stocks. I don't invest. I don't trade crypto. If you ask me how to build some long-term stock portfolio, I cannot help you. What I do is I day trade futures. Pretty much all I trade is NQ. So what even are futures? The textbook answer is that a futures contract is an agreement to buy or sell something at a certain price at a certain date. But realistically, for what we're doing, you do not need to overcomplicate it. I'm never holding one of these things until some future date. I'm normally in a trade anywhere from 1 minute to 30 minutes, and then I'm out. What actually matters is what the contract follows. NQ follows NASDAQ 100. So when NASDAQ moves, NQ moves. I'm not buying a company. I'm not buying shares of anything. I'm basically taking a position on whether I think the market is gonna go up or down over the next few minutes, and then I close the trade. That's literally what I do. Now, the reason I trade futures instead of stocks or options comes down to a few things. First, the market is open pretty much around the clock. Second, NQ moves enough in one morning where I don't need to sit there all day waiting for something to happen. And third, I can actively day trade it without dealing with the same restrictions you would have with certain stock accounts. For me, it just makes the most sense. Now, there's basically two versions of what we're trading here. You have NQ and you have MNQ. NQ is the bigger contract. Every 1 point NQ moves is $20 per contract. MNQ is the micro. Same exact chart, same exact market. It's just 1/10 of the size. So every point on MNQ is $2. For example, say the NASDAQ moves 10 points. If you have one NQ contract, that's a $200 move. If you have one MNQ contract, that's a $20 move. And the reason this matters is because NQ moves fast, like really fast. A 30 or 40 point move in a few minutes is not some crazy thing that happens all the time. And obviously that works both ways. The same size that can make you a lot of money can destroy your account and lose you a lot of money, especially if you don't know what you're doing. That's why if you're brand new, I would learn with micros instead of minis. And honestly, I wouldn't even start with real money. And I'll get into that in a second. I currently trade NQ, but depending on my account balance and depending on the day, I might even trade MNQ still with over 2 years of experience and over 5 figures in payouts last month. I'm going to say something that people probably won't want to do, and that's fine, but I would not recommend that a complete beginner start trading their own money. I don't care if you have $2,000 saved. I don't care if you have $50,000 saved. Having money does not mean you know how to trade. And putting all that money into a trading account before you even know what you're doing is probably one of the fastest ways to lose it. What I personally use are prop firms. If you don't know what a prop firm is, it's pretty simple. You pay for an evaluation account. That evaluation is basically a test. There's a profit target you have to hit, and there are rules you cannot break. If you hit that target without breaking the rules, you can have access to a funded account. Then, depending on the company and its rules, you can trade that account and potentially take payouts. The reason I like this model is pretty simple. Your downside is defined. If I buy an evaluation and lose it, I lost what I paid for the evaluation. If I throw thousands of dollars of my own money into a brokerage account when I have absolutely no idea what I'm doing, I can lose thousands of dollars, and that's a huge difference. This isn't a paid ad. I personally use Top Step right now as I'm recording this. I have 5 fundeds right now, all $50,000 fundeds, so $250,000 in funded accounts. Once you understand prop firms, the goal becomes way more clear. First, get good enough to pass the evaluation, then get good enough to actually keep the funded account, and then get good enough to consistently take payouts. Kinda. That's what they want you to think. But that brings me into my next point, which is a 50K account isn't really a 50K account. Now, this is something I wish somebody told me a lot earlier, because prop firms will advertise it something like a 50K account, 100K account, 150K account. And when you're new, you see that number and you're like, holy shit, I have a $50,000 account. Not really. The number you should actually care about is the amount you're allowed to lose. So say you have a $50,000 account, but your max loss limit is around $2,000. To me, that is basically a $2,000 account. That's the real number I care about, because that's the actual amount of room I have. But I think the big account number messes with a lot of people's heads. You see the $50,000 on the screen, you start treating it like it's this massive thing, then you start trading scared. You cut winners too early because you don't want to lose the money you just made. You hold losers because you don't want to accept the fact that you actually are going to lose. You start doing all this weird shit you normally wouldn't do. So once I stopped looking at the giant number at the top of the account, that doesn't really matter, and I started looking at the actual max loss limit, it became way easier for me mentally. It's a test. There's a defined amount you can lose, and that's what actually matters. Before I show anything on the chart, these are the 3 questions I should be able to answer before I click buy or sell. Number 1, what is my setup? And is my setup actually here right now? Number 2, what does a day look like where I should not trade at all? Number 3, how much money am I risking if I'm wrong? And did I decide that before entering the trade? Most beginners cannot answer those questions. They see something that looks pretty good, they enter, and then after they're already in the trade, they basically start making up a plan as they go. That's not trading. At that point, you're just clicking buttons. Everything I'm about to show you basically comes back to those 3 questions. Here's everything you actually need to start, and it's not much. First, TradingView. That's what I use for my charts. You can literally start with a free plan. Eventually, you'll get a prop firm evaluation, but not yet. And then you need somewhere to journal your trades. You can use a spreadsheet, you can use a notebook, you can use an actual trading journal software. It really doesn't matter. Whatever you're going to consistently use is probably the best option. I personally use a notebook, and that's basically it. You don't need some crazy paid indicator. You don't need a trading bot. You definitely don't need 6 monitors. I have 2 monitors because I trade full time and I like having the space, but I spent my first year entirely on a laptop. Do not make this more complicated than it needs to be. Now that you understand the basics, I want to explain what an actual trading day looks like for me. I normally wake up around 8:30 a.m. I'll just go outside, drink water. I'll like punch my brother in the face or something, like a very normal routine. And then once the market opens, my main window is from 9:30 to 10:15 EST. That's 45 minutes. And that's basically the only times I care about. I'm not sitting at my computer for 6 hours a day staring at candles. I want to be really focused when the market actually opens, because the open normally gives me the movement I'm looking for. And having a defined window also keeps me from doing one of the dumbest things you can do in trading, which is sitting there forever trying to force another trade. Now, I do want to clarify something. There can obviously be situations where a setup develops slightly outside the window that I just said. I'm not staring at a clock where the second it turns 10:15, I'm physically shutting my computer off. The bigger point is that I'm not trying to trade all day. I have a very specific part of the morning where I'm focused. And this is also why you can do this while having other things going on in your life. You don't need 8 hours. You just need a small period where you can actually sit down, focus, and trade properly. But if you're working full time and you're working during those hours, sneaking off to the bathroom and going on TradingView on your phone and trying to trade, it's going to be extremely hard. You just actually need to be focused. Okay, now I want to show you how I actually read and analyze the charts every single day. This is a summary of what I do. I'm going to make so many different videos on like actually what I do, but this is a summarized version. So I get on the charts at 9:15 a.m. every single day, sometimes even before. And the first thing I do is I'm looking at price action, and I want to identify if it's a high probability day to trade or a low probability day to trade. A low probable day would be a market that is just straight chop. First of all, I'm on the 1-minute time frame at all times. I don't care about the monthly time frame. I don't care about the weekly, the daily, the 4-hour even. I'm really just on the 1-minute time frame. That's because I'm basically scalping. I'm in a trade from 1 minute to 30 minutes, like I said before. I'm not swing trading. I'm scalping, right? So I really only care about what's happening on the 1-minute chart. So a day like this day, which was Thursday, August 6th, as you can see, I came into the charts and I'm looking at price action. I'm seeing swings, I'm seeing imbalances. I'm looking at this chart and I'm saying, okay, this is decent price action just from eyeing it. right? The first thing I usually do is I mark out certain draws of liquidity. Draws of liquidity are levels in the market where price is going to react to. They're very important levels in the market, and I need to mark those out before I even think about doing anything. The levels that I want to mark out are session highs and session lows, and then obvious swing highs and obvious swing lows. I personally have an indicator that marks out session highs and session lows for me. As you can see, it's called ICT kill zones. And then swing highs and swing lows, I basically can just and then mark them out myself. So in this case, this would be a swing high. This would be a swing high. In this case, there are no swing lows, right? We're kind of in no man's land down here. Swing high, right? So those are my high probability draws of liquidity in this case. The reason why I mark out high probability draws of liquidity is because we're either going to react to those draws of liquidity or go toward those draws of liquidity. I know those are very, very important levels in the market, so that's why I mark them out. So in this case, I always wait until 9:30. Remember I said I only trade between the times 9:30 and 10:15, that same 45-minute period every single day. So in this case, I'll wait until 9:30 opens up. So right now, there are no draws of liquidity lower. So we're not reacting off of anything, but I do see big displacement towards all of these draws of liquidity higher. So I could be waiting for a continuation type trade, but we'll see what happens. Okay, so as you can see, we have crazy displacement toward these draws of liquidity higher. So at this point, I'd be waiting for some sort of pullback just to get into the move. And then I would take profit at one of these draws of liquidity because I know they're very important targets in the market, very important levels in the market for me to target. Okay, I now have our pullback. Right now, I would not be looking for shorts because we're not reacting off of a draw of liquidity. We have crazy displacement towards the upside. We have crazy displacement towards these draws of liquidity. I'm now just waiting for a pullback, which we're getting right now. And then I would look for an entry after we get the pullback. So in this case, we are pulling back towards this displacement candle. We're coming back into equilibrium of this range. I then would look to go long, right? I would look to press buy if we came back to the original point that we displaced to, right? In this case, I'm going to set my buy order. I'm going to see if we come back to this original point that we displaced to, I would go long. I would set my stop loss below the rebalance wick, and then I would set my take profit at a point where I think we're actually going to go towards. Okay, we're now displacing. Okay, we're in the trade, so I'm going to put my stop loss below the rebalance wick. And in this case, I'm going to put my take profit all the way at level 2 up here because I can see us coming back all the way to these session highs. So I'm going to put my take profit at this level 2 just to make it about this is going to be a 1 to 1.25. So I'll let this play out. Okay, there we go. So that would be an example of a continuation. And now I'll show you an example of a reversal. Okay, now we have Monday, August 3rd. In this case, we do have a swing low that I am going to mark out before market opens at 9:30. Okay, now I'm going to wait for 9:30 to open. Okay, we took that draw of liquidity. So now I'm going to wait for a displacement off of that draw of liquidity to then look for a reversal. Okay, we got our displacement off of that draw of liquidity. So now I'm going to wait for us to come back into equilibrium of that range and then look to go long after we further displaced. Okay, I'm going to mark out our displacement range. Okay, perfect. We came back into equilibrium of the range. So now I'm going to set my limit at this top wick, which is where we originally displaced to. Okay, now we're in the trade. So I'm going to put my stop loss below the rebalance wick. In this case, I'm going to put my take profit at the highest session high. So we have about a 1 to 1.5 risk to reward ratio. And it played out. So that's a perfect example of a reversal. Obviously, that was like a very short explanation of the trade, but I gave you a continuation and a reversal example. The biggest thing I want to make clear is that I'm looking for one trade every single day. I'm not coming into the market with 9 different strategies. And I think this is where a lot of people screw themselves. They see one strategy on TikTok, they backtest it like twice. Then somebody posts a different strategy that looks maybe even better. So then they switch to that and then they lose 2 trades in a row and they switch again. You never actually get good at anything. For me, I want to see the same thing over and over again. I want enough reps so when it appears, I know what I'm looking at every single day. And realistically, you should be able to explain your setup pretty quickly. If somebody asks me what I'm looking for, I should not need a 20-minute explanation every single day. And after all that doesn't mean I'm taking a trade every single day. There are mornings where I literally open the chart and I think I'm not trading today. The market market could be super choppy. We could have terrible structure. Maybe there's news changing the conditions. Maybe there's no clear draws of liquidity. So in that case, I just wouldn't even trade. The point I'm trying to make is I don't need to trade just because it's a weekday and the market opened. And what I basically mean by that is detaching from the outcome. I literally had this written on my whiteboard in my room, and I would see it every single day. Progress can mean you took a trade and you understood exactly why you took it. Progress can mean you looked at the market, realized conditions sucked, and didn't take a trade. Progress can mean you took a loss without moving your stop. Progress can mean you journaled some horrible trade that you didn't really like at all, but at least you learned from it. None of that immediately puts money in your bank account. Your first month should be paper trading. So if I was to start completely from zero today, here's exactly what I would do for the first 30 days. I would not buy an evaluation. I know it's tempting, especially because some of them are really, really cheap. But if you don't know exactly how to trade yet, you're probably just going to gamble the account. You're going to lose it. You're going to buy another one, lose that one. And now you've basically learned nothing. Your first month should be paper trading. Fake money, real charts, real market, but no financial risk. And I would focus on 3 things. First, just learn how to actually place a trade, right? Placing a trade, setting a stop loss, setting a take profit, actually learn the platform. This sounds really basic until the market actually starts moving and you accidentally click the wrong thing. Second is to learn and recognize your setup. Come to the chart during the same window every morning. You're basically just training your eyes. And third, journal everything, every trade, even the bad ones, especially the bad ones. It's really important that you journal and you actually learn from your mistakes in the market. Now, backtesting. Paper trading gives you one live market every single day. Backtesting is where you can get way more reps. Now, honestly, this is where I got a lot of experience when I was unprofitable. You could either use FX Replay or TradeZella. I personally use FX Replay. You pick an old day, you hide what happens next, and then you trade as if it's happening live. And there'd be a few things I would do to make backtesting actually mean something. First, don't fly through the candles. I like replaying the market really, really slow because the whole point is to experience like the uncertainty. If you skip 5 minutes at a time, starting at 9:30 and suddenly see a fully formed candle, you're giving yourself information that you would not have live. Sitting there while the candle is actually forming is completely different. Second, make your backtesting account look like an actual account that you're planning to trade. If you have a $2,000 max loss limit, make your max loss limit on FX Replay 2,000. If your profit target is 3,000, make it 3,000 on FX Replay. Make it as realistic as possible. Match your account rules. Don't just go in with 10 NQ contracts because you know it's not real and the number is going to be big. If you're going to go in with 2 micros on your evaluation account, go in with 2 micros on your FX Replay account. Just make it as realistic as possible. Stay consistent with that, and then you can consistently learn. Now to journaling. Every trade goes in my journal, and I mean every trade, including the ones where I did something really, really stupid. Those are probably the most important ones to learn from. So what should you actually journal? Well, first, the conditions. Was this an actual good day to trade, or did I know the conditions were bad and I decided to trade anyways? Next, the setup. Was this really my setup, or did I basically convince myself that something kind of looked like it, so I decided to trade anyways? Then execution. Did I move my stop? Did I take profit early? Did I randomly change size? Did I do anything differently than what I planned? And then I would start writing down how I felt, right? This is how you track your emotions. Maybe every horrible trade you take happens after you miss an initial move, right? You start realizing patterns within your trading. Maybe you get bored after sitting there for 30 minutes and you start lowering your standards. After enough trades, you'll start to see the same mistakes over and over again, and you can actually learn from it. Your P&L only tells you whether you made money. Your journal tells you actually why. Now I want to get into mistakes I see beginners make all the time, and honestly, avoiding these mistakes can probably help you more than learning another entry model. First would be telling everyone that you're a day trader. I kind of did this, kind of didn't. A lot of people knew I was day trading. A lot of people had no idea, but a lot of people like to go online and tell everyone they're a day trader. Then everyone starts asking, how's trading going? How much money have you made? Meanwhile, you've made literally $0, and now everyone thinks you're an idiot because you haven't made any money. And I know this because that was basically me for an entire year. There's nothing wrong with making $0 when you're learning, but the random people asking you about trading aren't gonna understand that. So honestly, I would just keep it to yourself for a while until you're profitable, and then you have a high rise in Miami and a Lambo, and then you can just go tell everyone and their mother. But the second thing would be posting evaluation wins on your story, making it look like it's actual money. I see people make $1,500 on an evaluation account and then post it on their story and crop out the account type to make it look like they made that amount of money, knowing damn well they would never even touch that amount of money in any environment because they're an unconscious bloated jester. The next thing would be forcing trades. Maybe it's Friday, you're down on the week, you haven't seen your setup yet, and then the market randomly starts flying up and you feel like you have to be in it. That's FOMO. There's a huge difference between the market is moving and my setup is here. Next is knowingly trading bad conditions. This is one thing I had to personally work on myself. Before the market even opens, you should know, okay, this is a good day to trade. Okay, this is a bad day to trade. And when you say this is a bad day to trade, you turn your computer off, you go out and you go do something else. Like, you don't need to trade every single day. You trade high probability days, and this is why you journal. This is why you backtest. This is why you do all of this, so you know what days to trade and what days not to trade. The last thing I would say would be your habits outside of trading matter. If you stay up until 4 in the morning every night, you wake up whenever, you have no routine, you never work out, you gamble all weekend, that will reflect on the charts during the week. You can't just expect yourself to magically hop on the charts and you're gonna be an insanely disciplined person for 45 minutes every single morning. External habits lead to internal habits within trading. Definitely work on your outside habits and it will reflect on the charts. So after you've spent some time paper trading and backtesting, when are you actually ready to buy an evaluation? I wouldn't make it about an exact date. I would make it about your behavior. Can you go an entire week following your rules? Not, can you have a profitable week? Can you have a week where you consistently do what you said you were going to do? Because those are two completely different things. Once you can do that, then I think you're in a much better position to try an evaluation. And when you start the evaluation, I would not sit there obsessing over passing it. Your job is to trade correctly. Passing should basically be the result of you executing properly over time. Because the second you sit there saying, I need to pass this account today, you're probably not going to pass it. You're going to size up, you're going to force a trade, take something that isn't there and blow it. Focus on what you can control. Now, once you actually get funded, I do something that is definitely different from what people are going to tell you to do. I call it low cortisol funded trading. But before I explain, I want to make something very clear. This is not for beginners. This is for people with experience in the market already. The normal advice once you get funded is basically protect the account, trade tiny, slowly build it. And I understand why people say that, but the problem for me is that you can turn the account into some insanely stressful thing. You spend months trying to protect it and then you blow it and you barely have any payouts from it. What I do is different. I wait. I'm not trying to take a trade every single morning. I'm waiting for my A+ setup on a day that I already think has good conditions. And when I get that setup, I basically go all in on that setup and I build a huge balance. And then from there, I'll just secure winning days. I'll size down for the rest of the days, secure the payout and repeat. If I blow an account that first day, that's fine. But the method with these prop firms are to rinse and repeat. And it's not a shortcut. If you don't have the strategy, the back testing, the discipline, the ability to sit out, the experience, this is not going to work for you. Now let's talk about risk, because obviously none of this matters if you can't control what happens when you're wrong. First, you need to have a stop loss. If the platform you're using allows you to set a risk for the day or risk per trade, you need to be doing that. That's like one of the best tools. I'm surprised prop firms even allow it. You need to be doing that. Next, you should know how much money you're willing to lose before you enter. I normally risk around 1,500. If my stop needs to be wider, I just size down. I don't just randomly increase my risk because I really want to take a trade. And if I'm wrong, I'm wrong. I'll just take the loss. One loss also does not mean you need to make the money back that same morning. This is something that can completely destroy you. If you lose $500 and now the only thing you can think about is getting that $500 back, your mindset is very messed up. You need to wait for the next setup to get that number back, not just randomly enter to try to get that $500 back. It's discipline. That's how one normal loss turns into you blowing your whole account in one day. My rule is if I lose once, I'm done for the day and I'll be back tomorrow. So to make this extremely simple, here's how I would structure your first 90 days. Days 1 through 30, learn the basics. Open trading view, paper trade during your window every morning, backtest for 1 to 2 hours whenever you can, journal everything, and spend $0 on evaluation accounts. Your only job is to get reps. Nowadays, 30 through 60, if you've proven that you can actually follow your rules, then you can consider buying your first evaluation. I would start small, same trading window, same setup, same journal. Nothing changes just because there's an evaluation screen now. Your goal is to still execute. If you pass, great. If you spend 30 days trading correctly and you don't pass yet, that doesn't automatically mean you failed. Days 60 through 90, at this point, you're probably still working through evaluations. Maybe you're still working on your setup, or maybe you've actually gotten funded. If you're funded, now you're learning how to manage the mental side of having an actual trading account that you can take money out of. After 90 days, you still could have $0 to show for all of this. I know nobody wants to hear that, but it's normal. I literally went through that for more than a year without making any money. Remember, progress does not equal profit. What I would want after those first 90 days is a lot more important. I would want a setup I can explain in 30 seconds. I would want a journal filled with actual trades. I would want enough chart time where I can open the market on a random Tuesday morning and say, yeah, I don't like this day, I'm not gonna trade. That's what you're trying to build, and then the money comes after that. I also put together the exact pre-market checklist I use before I trade. It basically walks you through the questions I'm asking before 9:30. What am I looking for? What levels matter? What's my risk? Does this day even qualify? What would make me not trade at all? It's completely free. It'll be the first link in the description. It takes like 2 minutes to go through, so you can grab that and literally use it tomorrow morning before you trade. And if you go through this video and you still have a question, you can DM me on Instagram. It's at TommyGalvinNQ. I read all my DMs. If you got value from this video, maybe think about liking, maybe even think about subscribing. Otherwise, that's pretty much it.